Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in home studios today. A whole bunch of news that has come out in affected markets over the last several days, specifically starting with last Friday's jobs report on the heels of really good inflation information. And markets have really been bouncing around all over the place. So we got a lot to talk about today. I got some information to share with the audience that really wasn't talked about hardly at all in the mainstream media, which is a big reason why we do this show. We'll talk about all those reasons and all the specifics behind the events and news of the past week. But before we jump into that, Ez, good to see you again. And here we are, man, right at the beginning of August, wrapping up summer month here, dude.
I know. I never thought it would come, honestly. I didn't think it was coming.
Ready for it to be over. I can't wait to get past November 6th at this point.
Well, where I'm at, it has been unnaturally and unnecessarily hot. So, yes, I am waiting for the sweet embrace of autumn uh,
Yep.
myself. So,
Football season's upon us. We got preseason games coming up. Bengals playing here on Saturday at home against the Tampa Bay Buccaneers. A bunch of other games are kicking off this weekend as well. So, very excited about that and excited to get kids back into school.
my bad.
So here we are, right on the right on the heels of fall. So very excited about that. But lots to get into here today. So we'll kind of dive right into it. And as the audience, at least the viewers that have been following the program for a while, they do know that we send a lot of communication, a lot of content, to our customers. We do a monthly newsletter. The newsletter kind of summarizes what happened the prior month. What does history have to say about that? What can we look forward to over the coming weeks? Same thing on a Friday. We call it a blog. We just kind of do the exact same thing, except for that weekly blog on Friday is kind of summarizing that week. What does history have to say about it? What are our thoughts and expectations coming into the next week? We do obviously a bi-weekly podcast, which you're listening to here right now. And then, of course, we sit down with every customer at the beginning of every quarter, kind of going over results. What does history have to say about those results and our expectations over the coming quarter? So we do a lot of communication with our customers. And the reason why we do all of that is because it really helps us with two really key things as it relates to having success investing over a long period of time. And they all stem from advice coming directly from the best investor of all time. That would be Warren Buffett. I don't think that's really debatable, and it's certainly not going to be debatable on this show. But Buffett had to say that the main reason why individual investors do not achieve the results they're looking for consistently is they have no control over their temperament, meaning their emotions. And that's very important because you can, believe it or not, get a PhD in this topic called behavioral finance these days. It's fascinating. It just really describes how people make decisions under stressful circumstances as it relates to their money, their investments. And human beings are quite predictable. Comes to find out, we haven't changed all that much in a couple thousand years. We're hardwired with these emotions called fear and greed. And all that study showed is people feel losses twice as much as they feel good about making a profit. And in order to get control over those emotions, your temperament, to avoid the mistakes that most individual investors make that Buffett's trying to encourage people to do, the best way that we know how to do about that is understanding how human beings have behaved in the past. Human beings is what makes up a market. And again, we haven't changed all that much in a couple thousand years. So of all the different variables, all the different things you could try to analyze or predict or model or worry about, simply put, markets made up of human beings. Human beings have not changed all that much. They're hardwired with these emotions called fear and greed. They feel those losses twice as much as we feel good about making a profit. So just having that basic understanding, well, how have human beings have behaved under similar circumstances? So what are the circumstances? We have a Fed that's looking to cut interest rates. We have a labor market that seems to be resilient, although slowing down a little bit. Gross domestic production, GDP growth is 2.9%, according to the Atlanta Fed GDP's numbers that we just got a couple of days ago, which is above GDP growth. All that having to say is how have human beings behaved under these circumstances that we're in right now? And if you understand how human beings have behaved under these similar circumstances, now you can start to put probabilities in your favor, saying, okay, under very similar circumstances in the past, these are the sectors in the S&P 500 that performed the very best. right? Now you have probabilities. You don't have a guarantee of that past performance giving you some sort of guarantee of a future result. Obviously, investing involves risk, including risk of loss, but you're at least in a position where you have probabilities now in your favor. And you can choose how much risk you want to take with those probabilities, meaning how much do you want to overweight these individual sectors of the market, these individual stocks that make up these sectors. And that's really what this show is all about, is providing that historical perspective and using that historical perspective to build an asset allocation. Asset allocation being that second thing that you want to control. First being your emotions, second, the allocation. And why is 94% of the variability of your performance can be explained by your asset allocation. You have full control over that, just like you have full control of your emotions. And this show is really designed to help you get even better control over those two things so you can make more consistent, profitable, long-term investing decisions. Or if you don't want to do that on your own, we're just simply here to help. You can always hit us up 513-630-2664 with all of your questions. Going to the website, shepherdwm.com. You can reach us in a whole bunch of different ways. You'll find out everything that you want to know about our background as a firm, as well as my job here for our customers. So that's the point of the show. We're glad to have you here, and we're ready to dive into it. Is anything else that we need to make sure that we touch on before we get into the meat and potatoes of today's show?
No, I just want to remind everyone that we keep the contact line for SWN right up in the top of the podcast for those that are watching the live stream. Um, Also, as you know, Joshua mentioned, you can go to SWM website or through our YouTube page, however you're finding the Spotify channel, it can easily get you in contact with us. And I also would like to remind everybody that this show, um, while we do broadcast it for the public, it is a great way for us to reach all of the clients that Joshua handles. So we do encourage anyone who has a question, regardless of if you're actually a client of SWM or not, to drop all your questions in the live stream chat. Or if you're getting to this episode somehow later on and you have something you want to ask about, just leave a comment or something. Joshua will get back to you. So
Absolutely. We'll love the questions. We're getting more and more of them as we get into some historically volatile periods of a calendar year, specifically during election years. So keep the questions coming. But the primary question here today that we're going to spend a bunch of time talking about is, hey, we got really good inflation news. Last Wednesday, we got this really awesome press conference from Jerome Powell saying all the right things that you would expect him to say with all the positive inflation data that we've been getting, such as, hey, we're ready and prepared to reduce our monetary policy stance because we feel like the labor market is softening about where we want it to. We don't want to get it out of control. We're seeing inflation coming down in the right ways. So in that press conference, he made it very clear that rate cuts are now on the table for the very first time, beginning in that September meeting, right in the middle of September. And of course, the stock market loved that. And we've talked about it all year long. We've been talking about when is the Fed going to cut interest rates really since last fall, roughly a year ago, like I think around October, November, something like that.
yeah,
Um, that's when the Fed stopped increasing rates. Okay. Was late October last year. Market really rallied in November and December. And we came into this year, 2024, as a firm, as a leader of this firm, basically saying, hey, the Fed's going to cut rates. It's just a question of how many times they cut and when they begin that process. We've been calling all year long for rate cuts. We've laid out a bunch of reasons why, from a data standpoint. The rate cuts simply didn't happen as soon as we thought they would. And that actually forced us to change our asset allocation at that time. And now we're right on the precipice of our first rate cut. So we've been looking for this for quite a while. As a firm, and for those watching the show for the first time, you can go to our YouTube channel. You can check all the videos if you want to, but all the videos from this year, a bunch of them have been centered around this topic of when do we expect rate cuts, about how many rate cuts should we expect, and then more importantly, what does history have to say? Like, what are the sectors of the S&P? What asset classes historically do the very best as we go through these interest rate cutting cycles? We've been calling for it. We've been talking about it all year long. Thankfully, we got the inflation piece right. We've been saying that all year long, the first 3 months of inflation data were propped up by two things, that being autos and housing, that makes up the majority or close to the majority of the CPI calculations themselves. We showed all the data, although everybody was freaking out and thinking the Fed needed to increase interest rates because of those quote unquote higher than expected inflation numbers in the first 3 months of the year. We accurately got all of that correct because ever since the end of March, you've seen nothing but falling inflation across all of those metrics, not just the underlying inflation measures outside of autos and home, but now you're seeing autos and home, in fact, continue to fall precipitously. Every time we get another inflation measure. So we've gotten that part of the equation right. The next part of the equation is interest rates being cut. We also got that part of the equation right, given last Wednesday's press conference for Jerome Powell. What did that actually mean for our customers? It meant great performance, excellent performance. We overweighted the right sectors, small caps, industrials, financials, biotechnology, and we reduced our tech exposure, but certainly still own the technology stocks that really the best companies on the planet. And for those who've been watching the show, you guys know all about positioning there. But the first time we've underweighted technology in a couple of years. Tech being the biggest sector of the S&P, we were overweight that for the majority of this year. And right about the beginning of July, we begin to pare that back. And that was a really good call given the poor performance that we've seen here over the last month from the technology sector. Still going to be fine, specifically as we go through rate cuts. We'll talk about that here in just a little bit. But we got all this right. Now, last Wednesday, again, press conference from Powell, markets loved it. Our clients loved it. We were 100% right in our positioning. All that was not had anything to do with me being this super smart person or my business partner, John Ashcroft, being like this ultra intelligent, forward thinking. I mean, we are these things. We're not stupid, and we try to be as forward thinking as possible. But the reason why we got all this stuff right is because we're looking at internals. What does history have to say? What's the market not actually talking about? And what they're not talking about is what I want to spend time on today. So awesome news last Wednesday. We go into Thursday. Thursday, we get pre-markets. This is August 1st, are great. And then at 10 o'clock on that Thursday, August 1st, we got jobs data. And the jobs data, just to remind everybody, the market, the street, was looking for 185,000 new jobs added in the month of July. That number came in at 114,000, so way off what consensus was looking for. And the unemployment rate actually ticked up to 4.3%. The prior month, it was at 4.1%. And for those that are looking at this and needing some perspective, a 4% unemployment rate, or right around that number where we're at today, is considered full employment. So the Federal Reserve has two jobs. One is maximum employment, the other is price stability, that being inflation. So we've had unemployment box checked for quite a while. We've been under 4% for a very, very long time. All those things are good. But the jobless miss coming in at 114,000 versus 185, which is what the street was expecting. That caused a massive sell-off that continued all the way into yesterday, really. And unfortunately, nobody in the news was really digging into why did we miss so bad. All the news had to say was we missed the jobs report so bad. And the reason why we missed so bad is because the Federal Reserve left interest rates too high for too long. And now they're going to steer us right into a recession. That is the fear. Now, before we get into more, conversation about the numbers here in just a second, you have these two debating topics right now. Some of the people in the marketplace seem to think we're going to have a full-blown recession, and there's a lot of people that think that we're going to have a correction. That's kind of what we're debating right now. And typically, corrections are a fear thing. We're worried about something that might happen. Recessions are, we know something bad is happening right now, right? We don't know that to be true right now. So I would say that we're actually in this correction phase, which is really fear driven. Now, this is the important part here. And I do not understand why this wasn't specifically talked about and discussed in the major news outlets, but they stuck with recession as the issue, and that was the main topic. Now, when that news came out, everybody seems to have forgotten there was this massive hurricane that affected one of the largest states here in the United States, that being Texas. Texas dealt with a very large hurricane right at the beginning of July, and 1.3 million homes and businesses were impacted by power outages that lasted a couple of weeks. Unfortunately, the Bureau of Labor Statistics specifically stated that that hurricane had no discernible impact on the data and the response rates were within the normal ranges. Now, this defies logic to us at Shepherd Wealth Management because the state of Texas weekly jobless claims nearly doubled uh, in July versus June. Now, ex Texas, so take Texas out of the equation here, U.S. weekly claims were either flat or down across the United States from July versus June. Now, additionally, there was a massive surge in two areas of the Bureau of Labor Statistics jobless claims. There's a category called have a job but not working due to bad weather, and there's another category that says has a job but not working or working part time due to the weather. Okay. Now, in July, this category that usually full time but part time due to weather, in July for Texas, that number spiked to over 1 million. If you look at the 10-year average or the range for this same number in the Bureau of Labor Statistics, July 2014 through July 2023, the average that we're looking for, the range, was 73,000 to 229,000. So we got a number that's basically more than 5 times the upper range of that 10-year outlook that we just described, but somehow that wasn't statistically relevant in the jobless data. Now, the second category, even worse. There's a second category called has a job, but not at work due to bad weather. In July for Texas, this number was 436,000. The 10-year range is 10,000 to 60,000. But unfortunately, the Bureau of Labor Statistics said, yeah, the number is good. That 114, don't worry about the whole thing that happened in Texas with the hurricane. Even though 1.3 million American workers, most likely mostly working, just wasn't factored in. And therefore, we had this huge miss in the jobs number last Friday that's causing, I don't know, about $1 trillion worth of market cap to just evaporate because of this fear, right, that we're going to have a recession. It's a fear base. We don't know it's a recession. And for those that are calling for a recession, you don't even know the damn definition of a recession, right? You need 2 consecutive quarters of negative GDP, you know, unemployment rates to go up. I mean, there's a lot of different variables that have to happen at the same time and stay that way for a little while. 2 consecutive quarters is 6 months.
Don't
right?
forget the yield curve, my favorite recession indicator.
Right. So there's a lot of stuff that would have to happen. I don't know how in the hell, even if this was accurate jobs data, which clearly we don't believe that it is, right? Based on the numbers that you just heard, and for some reason wasn't talked about in the news. And the reason why, first of all, before I get into anything else, the reason why it wasn't talked about in the news, they're a business, they're here to sell ads, that's how they make money. There's nothing wrong with the model, okay? But if they know humans feel losses twice as much as they feel good about a gain, well, how they keep your attention is by causing some fear and panic, right? That's what keeps your eyeballs on the screen. You have to hear more. Like, are we actually going to go through this? Right? They're placating to that so they can be a profitable business. There's nothing wrong with that. You need to understand that as an investor, every time that you read an article online, every time that you turn on any news outlet, they're placating to your hardwired human being emotions, and it's just how they're running their business. And there's nothing wrong with that, but you need to understand that and say, well, what is it about this miss that can possibly be explained? Like, how did this happen? Well, now we seem to know exactly how that happened. Now, unfortunately, we have to wait till next month. We get a new jobs report, which will be on September 6th, so roughly a month from now. And this will be the deciding factor on this topic. Like, is this a trend of softening labor markets, or was this a one-time outlier that is completely explained for and accounted for by the Bureau of Labor Statistics not actually, adjusting their report due to the hurricane that affected well over 1 million Americans, in the state of Texas. Now, why they didn't give a little asterisk last Friday when they dropped that jobs report saying, hey guys, this is the number that we have here for you. But remember, this thing happened in this big ass state called Texas here in the United States that affected a lot of people. And there was a huge, massive outlier of data between what we've seen there in the last 10 years, right? That didn't happen. Okay. Maybe we shouldn't expect that. It is the government that's coming up with all this stuff. So, there's something to be said about that, I suppose. But, this is all public information. This was not hard to find.
Yeah,
You
it
had
was
a,
PEDs. This jobs report, it was taking PEDs and they didn't let anybody know it, you know?
yeah, and we put all the data, right? In this is a newsletter that we sent to clients. I sent it to them, I think this Tuesday, this past Tuesday. And we took the data, right from the internet and said, here you go. This is what the Bureau of Labor Statistics is pointing to. And, there's a whole chart of the last 10 years of both of these categories. And we put it in there. So the numbers are what they are, and they're certainly not lying. So I'd be willing to bet here that this big volatile moment that we've seen in the market was nothing but a buying opportunity. And you're seeing, real life human emotion. Like that's what the market is on a day in and day out basis. It's a live autopsy of human emotion. People are selling first and asking questions later, right? That's unfortunate for even us. Like we were prepared for the inflation data to come in the way it was. We were prepared for Jerome Powell to say what he said last Wednesday. We were prepared for all of these things as it relates to earnings, etc. We did not expect as soft of a labor report that we got last Friday. We did think it would be softer, but we didn't think it would obviously come in the way that it did. But more importantly, we did not expect investors to react the way that they have. Bad news is, in fact, bad news now. And we'll see how that may change here in the coming months as more and more data comes out. But the reality is, from a recession standpoint, I don't know how you can come up with the equation that gets you to recession with unemployment right around 4%, GDP tracking at 2.9, which is well above trend historically. You've seen earnings this entire earnings season and earnings all year have delivered. None of that. I mean, the best indicator of recession is jobs. You see a massive spike in unemployment, 5% or more. That's a great indicator that you're going through recession. And you're just not there. You're not even close to that in any way, shape, or form. So to us, this was a huge buying opportunity. As I mentioned at the beginning of the show, we've been paring back the sector that we've made the most money in for clients. It's the biggest sector in the S&P. We've been doing it really since the beginning of July, reducing tech. We took a lot of that capital. We applied it to a little bit of industrials. So we're overweight industrials as a sector, and we're way overweight small caps as an asset class. Small caps is not one of the 11 sectors of S&P, but it is, of course, an asset class you can invest in. And we've talked about all the reasons why. We're very big into small caps and industrials. I'll touch on some of those things here in just a little bit. And the trade has worked very well up until last Friday. Now we're starting to see the recovery of all the losses that have taken place since that jobs report last Friday. And it's really been a two-step forward, one-step back kind of month so far here in August, which is historically volatile, specifically during election years. So as it relates to as history would have to say for small caps, as difficult as the last 3 trading days have been, the probabilities still favor a strong second half of the year. Now, since 1950, when the S&P 500 is up greater than 10% in the first half of the year, just like this year, this has happened 23 times since 1950. And the second half gains have averaged 9.5 or 9.8%. And there's an 83% probability that this will be correct. In other words, an 83% win ratio over all 23 of those years. So 9.8% average gain, and you're going to win about 83% of the time. The 4 negative second half instances of those 23 years, 1975, 1983, 1986, and 1987. Essentially, all those negative years were the Paul Volcker being the chairman of the Federal Reserve during all of those years. And as we all know, those were the highest inflation readings we've ever seen here in this country. From a monetary policy perspective, the Fed certainly was not doing press conferences. They were just making decisions, and the market would find out about it, a couple of days later. So that's the way that they were doing things back in the 80s and late 70s from a monetary policy perspective, and that is not the case today. So it seems like there's a very high probability that the back half of this year, relative to what history has to say, is still looking at maybe a double digit type of move, even though that feels very unlikely to a lot of people at the moment, just due to all the fear that they felt over the last couple of days, given that jobs report. Now, additional data here as it relates to small caps from a historical perspective. Again, our favorite asset class in the second half of the year for our customers has been small caps. We're still constructive on this. The 3-day sell-off has been painful, but the fundamental and technical case for small caps remains strong. For instance, the small cap Russell 2000 rose 12% and then fell 7% as we got that jobless claims reaction last Friday. Now, that is shockingly rare, okay? Since 1979, this has happened 9 times where we've seen small caps move up double digits and then fall, 7% or more just a couple of days after having a positive move. So this has happened 9 times since 1979. Now, small caps are up more than 10% and then fall 6% or more over a 5 trading day. Again, happened 9 times. The only negative instance was March of 2000. And that, of course, was the start of the bear market. Outside of that one instance, the other 8 instances saw 1 month, 3 month, 6 month, and 12-month returns, all positive, with the 12-month being 36%. So there's a lot of historical reasons why we believe the market as a whole will be really good, really strong in the back half of this year. It might take all the way post-election, November 6th, those gains. That's okay too. Last year was very, very similar. Between August 1st and the end of October, that 3-month stretch, even though the market was up 22% last year or so, that 3-month stretch saw the S&P down 10%. And the main reason for that is we're still fighting inflation. The Fed was increasing rates. We peaked out at 9.1% inflation September of last year. And we finally got the first inflation news in October that showed that inflation was in fact falling. Fed does their announcement, says we don't want to increase rates anymore. We feel like we're sufficiently restrictive. And the market went on a tear between the beginning of November and the end of December last year. Specifically, small caps saw a 27% move over the last 8 weeks of last year without a rate cut in sight. So now we're looking at a first rate cut. And after this sell-off in small caps, I think we'll really set up well with a fundamental, technical, and historical perspective to actually realize a lot of these types of gains that history would suggest that we might experience. Now, some of you may be asking, well, what about valuations? Are small caps, even profitable? Are large caps too expensive? Well, let's talk about valuations here to wrap up today's podcast. The Russell 2000, as we're sitting here today, is trading at a 40% discount to the S&P 500. If you're looking at the forward PE ratio for 2025, right now the Russell 2000 is at a 40% discount relative to the S&P 500. Now, that is also shockingly high. The median price to earnings ratio for small caps is currently 10.5, whereas large caps is at 17.8. Now, even if you look at, okay, what about really cheap stocks, those in the second quintile, third quintile, fourth quintile of all of these Russell 2000 positions? Well, on the low end, all the way to the most expensive Russell 2000, and comparing that to the cheapest stocks in the S&P versus the most expensive stocks on a PE perspective in the S&P, across the entire curve, small caps are less expensive than large caps. So the risk reward, specifically after the sell-off that we've just seen, and again, this is on the heels of really good inflation. Interest rate cuts are now being priced in the market. They're actually increasing the probability of those cuts as we're speaking right now, with unemployment still hanging around that 4% number. All of this is a great backdrop, even though it might not feel like it emotionally after that jobs report and the reaction after it. Right now, you have a really beautiful backdrop for excellent performance between now and the end of the year. Is it going to go up in a straight line? Absolutely not. You're going to see, again, probably 2 steps forward, 1 step back kind of movement between now and the election, and then historically speaking, after the election. And that unknown is now known, whatever the outcome is, of course. Markets tend to react and behave pretty well. And we're very, very excited about that. So we're really just using, as Warren Buffett would say, all these emotions that investors have to our advantage. When everybody gets fearful, we get very greedy. Once everybody else starts to get extremely greedy and you see margin debt, increase and a whole bunch of cash flows coming from treasuries into ETFs and equities, all that's are great indications of, okay, now it's time to start rebalancing a lot of these gains out of our portfolio and to start considering getting a little bit more conservative from an allocation perspective. And I really hope that this was helpful. I know that our clients really loved us getting this data to them quickly as they're sitting here watching, CNBC all day long and seeing all the red across the screen and, some of the best companies on the planet like NVIDIA, down damn near 30% over just a couple weeks span of time. All this emotion, feels like it's never going to end. But hopefully this sort of data has calmed you the way that it's helped calm all of our customers. They now understand, the numbers behind the numbers. And now it makes very clear sense to them as to why everybody else is acting irrationally. Now we can react not only rationally, but in a calm manner and make some really excellent decisions that we think will be, a huge hit for our customers from a performance standpoint by the time we get, to September's first rate cut. So we're very, very excited, even though we're dealing with a ton of volatility right now. This should be a huge opportunity for folks that are willing to spend the time, understanding what this data actually means and what history has to say about it. So I certainly hope this podcast was helpful. I know it really helped a lot of our clients. We haven't gotten any phone calls after we pushed that data out to them because, again, they hadn't heard it. Nobody was on TV talking about this stuff until we were able to bring that to their attention. And definitely has helped us, not just us as business owners here and financial planners, but it's also certainly helped the stress level of our current customers. And I hope it's done the same for you as well. So with that, I think we've gotten it done here once again, dropping some knowledge on some folks that they might not have heard before. And we look forward to doing this again in a couple of weeks. So we try to do this again every 2 weeks. We'll see how that works out with both of our schedules. So we'll try to do this maybe right before the end of the month here. And we'll have a lot more to share because we're going to get a whole bunch more data as far as stuff that's getting ready to come out. Next week is a big week from a macro perspective. We get core PPI, so kind of wholesale inflation numbers next Tuesday, August 13th. We get headline inflation the very next day on Wednesday, August 14th. CPI is coming out Thursday the 15th. We get initial jobless claims. We get some retail sales numbers on that same day. And then we get some home building information next Friday as well. So every day next week has a lot to it. Therefore, by the time we do this again, we'll have a lot to say about it. And we certainly hope that you guys will be here to join us for all of that. So until then, hope you guys have a great rest of your day. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Wishing you a great rest of your day. We'll see you next time.